Hey, what's up? In this video, I'm going to tell you a legal way to avoid paying taxes. That's exactly right. Income taxes being zero, and doing so absolutely 100% legal. It's the techniques that the wealthiest people in this country have been using for years, decades, centuries. Now, before we begin, I want to make sure you understand I am not a tax attorney, I'm not a CPA, I'm not a bookkeeper, I'm none of those things. I'm not an accountant. I'm just a guy teaching you what I think I might know about taxes. If you want real advice, hire someone, a CPA, a tax attorney, somebody that's going to help you with your taxes. Before I get into how to avoid paying income taxes, I want to make sure you understand what income taxes really are. Do you remember the first time you ever worked a job and you opened up that paycheck? Maybe you had worked 40 hours that week at $10 an hour and you were expecting a check for $400. But what happened? When you opened that check, you noticed that the amount was not $400. It was significantly less. Taxes had been automatically taken out of your paycheck, seemingly against your will. And as you started reading that pay stub, you found out that they're taking money out for federal taxes, for state taxes, for Medicare, for Social Security. They're taking money out of my check without my permission. Though that might have been the first time you experienced the government taking money from your check, many people still haven't learned about income taxes. When you file a tax return and get money back, many people think that the government is just being benevolent and giving them some money. That's not the case at all. What's happening is that the government is returning your taxes that they took from you out of that paycheck that's documented in that pay stub. So on that $400 check that they took $100 out of, the government is now returning a portion of that back to you. Sure, there are some credits and sure there are some things that can happen on your tax return, but for the most part, what you're getting back on that tax return is just that, a return of your taxes. A lot of people don't understand what the government is doing from an income tax perspective, how much money they are paying in income taxes every single year. And the whole system is set up so that it's purposely confusing. Some of the smartest people I know refuse to figure out what's going on with their income taxes. So my point is that as you work and as you earn income, you are paying taxes, regardless of whether or not you get a tax return at the end of the year. Now, many people have a different opinion about paying taxes than I do. They believe that they should, quote, pay their fair share, that the government does a really good job spending money. I don't have that opinion. I believe our government wastes our money, uses it for things that I don't agree with, and therefore I have a goal to pay as little taxes as possible. I would much rather determine what my money goes to through the different charitable contributions than what the government automatically forces me to contribute to. So the way I look at it is I want to pay as little taxes as possible. Now, I still pay a lot in taxes. I pay a lot in property tax, in sales tax, in fees that get charged by city municipalities for doing any kind of construction. But when it comes to my income tax, I want to pay as little as possible. And right now, I'm going to teach you how you can pay as little as possible, sometimes nothing, in income taxes, and doing so absolutely legally so that nobody comes knocking on your door saying you owe us some money. And the primary way to avoid income taxes is holding rental property. You see, when you hold rental property, you get this thing called depreciation, and depreciation is a bonus that the government gives for those who hold rental property specifically. What they do is they take the value of that house, divide it over 27.5 years, and allow you to reduce your tax burden by that amount over the next 27.5 years. So let's take a $100,000 house, divide that by 27.5 years, you get $3,636.36 in depreciation every single year. So for instance, let's pretend you had a rental property producing $300 a month after all the expenses, taxes, insurance, management, maintenance, and vacancy. You were netting $300 a month. That means that you're going to make $3,600 in income from that property. Well, if that house was worth $100,000 and you're able to depreciate that over 27 and a half years, you are able to reduce your income by that $3,636 against the profit that you just made on that rental property. So quite literally, you are able to show that you made no money on this rental property, though you stuck $3,600 in your pocket. Man, that's great. You don't have to pay income tax on the $3,600 that you just made because of the depreciation from that rental property. Multiply that by 10. So you have 10 rental properties, all performing that same way. You made $36,000 that year and not having to pay any taxes. So now multiply that by 100. Having 100 rental properties, cash flowing $300 a month, $3,600 a year, that would be $360,000. And because of the depreciation, just the depreciation, you are able to not pay any money in income tax because you are showing the government, based on this incentive to hold rental property that they have put in the tax code, that you didn't make any taxable income. Therefore, you don't owe any money in taxes. Pretty nice, huh? Now that works for 27 and a half years. At the end of that 27 and a half years, the depreciation falls off. Now you don't get that depreciation. So what do? You got to make a choice. Do you pay taxes on the gains that you're getting from that rental property? Or here's what most investors do. They sell that property, buy another property, and restart the depreciation over again. Now I'm not a CPA. Make sure you talk to your certified public accountant, but these are the kind of benefits that the government has used to incentivize investors to hold rental property long term. Now that's just one strategy, the depreciation strategy. The second strategy to avoid paying income taxes legally is to own your own business and to have expenses. When I travel and go to other markets that I may consider investing in, like Miami or California or New York, I will make sure that I use that as a business trip. And any kind of business expenses get pushed against all the profit that I make. What are all of those business expenses? Well, it could be rent, it could be travel, it could be marketing, it could be a number of things that are done in the course of business to be able to try to make that original $100,000. So for instance, in June, I'm going to a real estate conference in Orlando, Florida, as a business expense. See, that conference is designed to teach me more about real estate. It just so happens to be in Orlando, Florida. Be careful with this. Make sure that the business expenses are actually business expenses. Only me, the employee of the company, is allowed to write those expenses off as business expenses. But my family, going out there, going to Disney World, having a bunch of fun while I'm in this real estate conference would not be a business expense. That would be more of a personal expense. But where a lot of people fall down is when they have their own personal expenses and never roll them into or never consider them to be business expenses. Why wouldn't you start a business, an LLC or whatever, and run some of these expenses through there? Whether that's rent or office supplies or payroll, education, travel, or a number of things. So it makes some people nervous to classify certain expenses as business versus personal. In order to do that, you need to have your own organization, you need to have your own entity. Run those expenses through that entity is the safest, easiest way to do it. Can you, with your CPA, try to classify certain expenses as business, though it came out through your personal account? You can, but again, talk to your CPA, talk to your bookkeeper about all that. But let me just give you the example. Some of you make $100,000, don't classify anything as a business expense, and then the tax bill comes, you got to pay 25%, and now $25,000 of your 100 grand gets given to the government. Rather than giving that money to the government, let's pretend I make $100,000 in a year, but I have business expenses that total $100,000. I make $100,000, I spend $100,000, my taxable income is zero, therefore I pay no taxes. See, my admonition to you is to figure out how to pay as little income taxes as possible so that you can determine what you want to do with that money, that you now give to these other organizations, nonprofits, or whatever it might be, and those kind of things could be considered business expenses. That's the strategy. So now let's put both of these strategies together, the depreciation and the business expense strategy together. Instead of having a property that throws off $300 in cash flow, let's say we have a property that throws off $600 in cash flow. That'll come to $7,200 a year. Well, we know that first $3,600 will get depreciated, so we don't have to worry about the income tax on that. But what about the next $3,600? Well, that's where we start using that $3,600 for business expenses and therefore reduce our taxable income to zero. Just because you get the benefit from it as a business owner doesn't mean that it wasn't a business expense. When I upgrade my laptop, that's a business expense. When I travel to another market to determine if I'm going to be buying deals there, that's a business expense. Doesn't matter that it might be on a beach. Doesn't matter that it might be near a resort, a golf course, because it's a business expense. It's something that I can justify to the IRS that I did for business purposes. And now you can see easily how you can avoid income taxes long term. Buy rental property, experience the depreciation, make sure that all of those expenses go against your net, and all of a sudden you're able to determine what you do with your income rather than giving it to the government and letting them decide. Hold rental property. Helps you avoid income tax and build wealth down the line. Now, let's say that $100,000 house turns into $200,000. Now you sell that rental property, buy another rental property, increase your cash flow, avoid paying taxes, do a 1031 exchange so that the government knows that this old house is no longer in the picture. This new house is, continue to add depreciation to it, avoid paying the capital gains taxes on it, and move it on down the line for the rest of your life. Now, some of you are saying, man, that's great, but Brad, I want to avoid the income tax that I'm paying right now in my 9-to-5 job. Wonderful. Let me teach you how to do that. Let's take the same scenario with that rental property that cash flows $300 a month. Let's reduce that $300 to zero because of business expenses. Now we're showing that we have a rental property that makes $0 per month in cash flow. But just because it's making $0 a month in cash flow doesn't mean we're excluded from the depreciation. We still get that depreciation. So that $3,600 in depreciation goes against our regular income. Now let's pretend we have 10 of those properties in the exact same scenario. Now we have $36,000 we're able to put against our salary. If you have a job that you make $36,000 and you have 10 rental properties, all cash flowing zero, the depreciation would wipe out the total amount of income that you make, therefore making your taxable income zero. And when you have zero taxable income, you don't pay income taxes. In fact, what you get is a bunch of other bonuses coming your way. Could be an earned income credit, could be a child tax credit. You get a lot of money given to you by the government. Now let's say you have 100 properties, but you spent $360,000 on business expenses. Again, whether that's technology upgrades, travel, by now you might need to hire people and pay salaries. But that $360,000 in expenses go against the cash flow of the rental property. But the depreciation is still there for all 100 properties. So you can then take that $360,000 against whatever active income you make. If you're a doctor, a lawyer, a dentist, whatever it might be, now you can take the depreciation from your rental properties against your active income and pay $0 in tax. How amazing is that? That's how the wealthiest people in our country avoid paying taxes, build their wealth, and increase their cash flow over and over and over again, following these principles. So again, I'm not a CPA. I'm not a tax attorney. What I just told you, those strategies have served me well, but they may not serve you well. Your tax situation may be completely different than mine. All I know is a lot of wealthy people have used these exact strategies, the depreciation strategy and the business expense strategy, to avoid paying a large amount of taxes. So follow this advice, talk to a CPA, and make it so that you're setting up your financial picture the way you want for it to be. Build your wealth, increase your cash flow. I'd love to talk to you about doing deals. Give me a call. Let's figure out if us doing deals might help you avoid paying serious taxes down the line. Hey, thanks a ton for watching. Please do me a favor. Like, subscribe, and I'll catch you on the next one.